gentlemen, welcome to UOB Kayhian again, and I hope you are keeping safe and well. Desmond here again. I think some of you may have attended my previous session from the stock picking session, strategy sharing session, as well as the fundamental analysis classes, and thanks for support on that. So for today's a prelude to picking winning stocks, what I'll do is that I'll go through some basics and run through with you some most important but yet easily forgotten facts, which I would say basically these are the building bricks in helping you to become better investors. Just going to share with you how stock investing works. You can either invest through by yourself, or you can actually buy through mutual funds. When we talk about investing by yourself, you can actually engage your dealers, your remiser, or even you can trade by yourself. And again, when we talk about stock investing is not merely just a ticker that you see, like Top Glove or Harta Lega or Inari or D&O, this kind of stock tickers that you see in the Bursa screen itself. Basically, behind a stock, there is a stock ticker that I mentioned to you just now, and behind the ticker, there is a company running at the business. So stock investing, indirectly, you are actually participating in a business. So how the share price of the stocks actually move up is that when the demand, which means the buying of the stock itself, is higher than the supply, which is the selling, the share price actually move up eventually. So the share price will move up according to a few factors. One is either the company is expected to see much higher earnings going forward, or vice versa, there are good news whereby the stocks will see a turnaround, or the stocks will basically secure some of the big contracts, which I'll go through with you again on the different kind of stocks itself, on how you should look at it. And on stock investing, it's very important for you to differentiate between investing and speculating. And essentially, when we talk about stock investing, you actually pay for a business. You do not merely just pay for a ticker. The right intention, knowledge, and experience are much more important than the qualification itself. The difference between fundamental and technical analysis is that before I run through the fundamental analysis, just to give you a sense that fundamental analysis involving engaging the security underlying intrinsic value. Basically, these are the value of the company, or you can also define as the target price of the company, which I'll go through with you later on. And technical analysis involves the study of a past stock price behavior by looking at the historical price. So looking at the fundamental analysis, you need to take into consideration of economic, industry, and company factors, whereas technical analysis, you only need to look through the historical share price. And fundamental analysis will go through most of the time involving by having a longer term position, whereby technical analysis are more suitable for swing traders as well as short-term day traders, because they always study the share price pattern in minutes, in hours, even for lack of days. So ultimately, fundamental analysis involving the expectations versus the results outcome, and it also examines the current development versus the historical events, and hence derive the intrinsic value of the company. So whereas technical analysis involves in the trends, in looking at the trends, support, resistance, and the price patterns of the company. What is fundamental analysis? Again, it basically involves in determining the intrinsic value of the stock, of the equity share, and it examines various factors, i.e. the earnings of the company, the growth rate, the risk exposure that affect the value of the company. And fundamental analysis is very important, this point, involving the earnings forecast and expected returns, because fundamental analysis involved in determining the intrinsic value of the shares itself. And when you buy shares or stock investing, you basically wanted the share price to go up, the value of the company to go up. So how do they determine whether the value will go up and down? Of course, looking at the earnings forecast of the company, whether going forward will it make more money, or going forward will it make less money, or will there be any turnaround stories, or the business, is it cyclical, and things like that. So essentially, fundamental analysis that will examine the intrinsic value, you need to involve in the earnings forecast and the expectation of various factors, i.e. earnings of company, growth rate, and various factors. So there are two ways of looking at the fundamental analysis. One is top down, which I most of the time I use this way, top down approach. So look at the trends, top down approach. Look at, if imagine you have not invested in the stock market right now, you look at the global factors. Currently, COVID-19 is actually still basically the most common the most common factors that will affect the market itself, yeah. And then right after that, you look at the country specific factors, which are the countries that are seeing a monetary or fiscal policy, and what could be the investment risk or the interest rate risk on that. And then you look at the sector specific factors, which are the sectors that will continue to earn big money, at least for the next 6 to 12 months. I think these are something like commodities, and also these are something like your technology stocks, right? And last but not least, looking at the stock selection, you look at quantitative and qualitative analysis, which I'll go through with you again later. So quantitative, involving into the number analysis, looking at the financial statement, and qualitative analysis involving into the management analysis or business analysis, yeah. So again, bottom-up approach, you can actually use stock screener, look at quantitative and qualitative analysis, like how many times of PE of stocks that you would like to look at if you wanted to do some value investing, and then stock selection based on that, sector weighing, and last but not least, on market exposure. So generally speaking, just to share with you, during time of economic expansion, risk in equity is particularly low. And during times like this, investors should adopt an aggressive growth-oriented strategy, and they should actually look at cyclical stocks such as technology, semicon, commodities, and materials. Material kind of related kind of stocks, because during time like this, the cyclical stocks are highly sensitive, and their earnings is highly dependent on business cycle. So when the business cycle tends to pick up on economic expansion, these are the sectors that will be benefited the most. Vice versa, during economic contraction phase back then, early of the year, last year, the risk in equity is high. One should actually adopt a defensive strategy, and they should look at fast-moving consumer goods such as Nestle, utilities, Tenaga, healthcare, IHH, rubber glove, with the like of Top Glove, Hata Lega, and things like that. So, sorry, I would like to make a small amendments over here. I think rubber glove right now is cyclical. They are non-cyclical when there's no pandemic. But most of the time when pandemic or any endemic comes, right, it will turns to become a cyclical stocks. So why you should actually look at non-cyclical stocks during economic contraction phase? Because their earnings are not heavily affected by the business cycle. That's the reason, yeah. So just to share with you on the market, how I look at things from top-down approach. Back then, when I do my sharing in April, May, June, July, even latest August, which you can view my presentation again. So I'm saying that the slow vaccine dispensation could actually affect the market, and effectiveness against the variants, hence delay in full economy reopening, and hawkish surprise from the FOMC meeting. I look at the US side, and then I look at the overall inflation risk, political risk, and last but not least, I mentioned the risk and reward from the US market is not as great. But I think right now US market is doing quite well, but I still stick to my own conviction that I think US market tends to see a choppy market going forward. I think especially these few months time, yeah. So from top-down approach, I also look at the Dow Jones level, Nasdaq. I look at the insti retail foreign participation. Then, last but not least, I look at the sector-based as well as the local economic condition and how to position amidst the noises. I advocate investors to look at banks, to look at commodity stocks such as MSC, such as precious metal. Then I also advocate investors to have a barbell approach by having some structural growth for alphas on technology stocks such as QuickTech, Inari, VS. These are the stocks that have done tremendously well. And I also advocate investors to have some reopening play picks because I see some good value in Genting itself. Of course, the Genting is not performed as great as technology commodities, but at least it's still making money. And on the value investing, we advocate investors to buy on dips, on defensive business model, on some bank names and telcos, and yield plays with resilient business. It turns out to be quite well, which you can actually look at the write-up or the presentation done by me ever since March itself or beginning of the year till today. And just to share with you how you actually should read the analyst report is that on analyst report, besides target price and the recommendation, you should look at the angle that they're coming from. So the angle, this report, Great Tech, is actually written by me. Back then, I advocate a buy call. I think target price could easily hit 7.20 ringgit. Back then, when the share price was at 5.45. Of course, when I first called buy call, the share price only at 2 ringgit. No, I think maybe 2 ringgit. Yes, okay, it's only at the 2 ringgit. Till today, it's become 7 ringgit already. So I mentioned that back then when it was at 5.50, you can see they are actually affected by a non-eventful stuff, which you can read through my report again later on. And I mentioned that they are prospering for First Solar huge investment. That's why I stick to my forecast over here. So when you read an analyst report, besides looking at the buy at the target price, the investment thesis, why they call a buy call, you should also look at their forecast, how they derive their forecast over here. So there are explanation over here and also how we derive our target price of 7.20 ringgit. 7.20 ringgit, how you derive here. And on the buy call, why is it a buy call? Because we see value undermining the growth itself, and we see robust earnings going forward that will catalyze the share price performance. And up till today, I think share price 6.90 ringgit today is still performed tremendously well. So I'm just having a light touch with you also on this fundamental analysis. Again, like I mentioned, two things we should look at. One is quantitative analysis. The other one is qualitative analysis. So on quantitative analysis, we look at industry and company. Qualitative analysis. We look at elements in industry analysis. On top-down approach, say you wanted to invest glove stocks, right? You need to study relationship between macro data or industry trends. So right now, COVID-19, of course, there are a lot of demand over glove, but because of China coming out with ample supply at the same time, a lot of people actually put on vaccine already. Hence, gloves are not in high demand again. So you need to study that relationship and estimate the industry variables. So in the glove stocks itself, what are the key determinants that will affect the earnings? Obviously, it's the average selling price, and then at the same time, the cost, the nitrile butadiene rubber, which is a raw material cost, and perform scenario analysis on that. You also look at the consensus and relative valuation. So when we talk about relative valuation, you look at the industry valuation across the time, or you compare with the different industry. So industry valuation, you look at the last time during H1N1, during other endemic or pandemic, what sort of valuation it is trading at, and once they pass that, what sort of valuation it will be trading at as well. So right now, I think glove stocks is not performing as well because I think the peak of the earnings is actually over. Now people look at normalized earnings. That's why you can see share price will keep coming down, because even though current earnings are still good, people are always forward looking. That's why when I talk about fundamental analysis, it's always important to have one thing in mind, which is the earnings forecast. You need to have a sense of what will be the earnings direction. So again, on these last 4 things, analyze the industry prospect, determine the life cycle stage, external force, and examine the forces that determine the competition. I will share with you again on our advanced or intermediate course later on. And elements in when we talk about company analysis, you need to look at, of course, when you buy into a company, you need to look at what sort of business it is running at, and the industry characteristic, the info on operations, type of products and services that is actually providing. Let's say Top Glove again, glove company, 50 over plants that providing glove for nitrile glove, latex glove, industrial glove, and so on. And what's the product demand, cost, and pricing environment? And at the current average selling price of nitrile is currently running at 30 to 40 US dollar per 1,000 pieces, compared to last time peak time 120, even up to 150. So the peak is over for glove stocks. And you also need to look at on the company analysis whether the company is using cost as the leadership or the differentiation of products as the competitive strategy. So like glove, right? Glove is mostly using cost as the competitive strategy. So imagine if you go to buy glove in the market, do you choose brand? You don't, right? So basically you just look at the cost itself, because glove itself, different kind of brands serve the similar kind of purpose, right? Which is to insulate the virus or insulate the risk or insulate the contamination. Unlike when you look at technology stocks, if you want to buy a handphone itself, brand differentiation, if you want to buy a stocks such as Apple, such as say Alibaba, you need to look at the brand differentiation, right? Just like when you buy a handphone, you don't just look at cost itself, you look at what kind of brands that they provide. So in company itself, company analysis, you need to have a really important um, definition or understanding on whether the company is using cost as a leadership or differentiation of products as a leadership. So you need to look at, of course, the financial condition, corporate governance, the strength and weakness, opportunity and threat of the business, and the projected financial statements and firm valuation. I will go through with you in depth again on our upcoming presentation, which will be, I think, should be on the 18th of September, next Saturday. Yeah. So maybe just a quick light touch on financial statement analysis. There are 3 key things to look at, which is your income statement, balance sheet, and cash flow. Income statement tells you how much the company own and how much company spend. How much company earn and how much company spend over a period, usually quarterly, yearly. And balance sheet, it tells you how much the company own and how much the company owe. And on cash flow statement, of course, it tells you the movement of the cash itself. So income statement, maybe quickly run through on income statement, 3 key things you need to look at, which is the sales growth and the profit margins and the earnings per share of the company. And on asset, on balance sheet, again, it tells you how much the company own and how much they owe, right? So balance sheet, debt to equity ratio, it tells you the financial health of the company, return on equity or returns of the shareholders' investment, which I'll go through with you on this definition again on our intermediate and advanced course. Today is just an introduction. Book value per share, it tells you how much the company equity attributable to each shares. Cash flow statement, again, 3 key things. Operating cash flow, it tells you the net profit versus the quality of earnings, and the investing cash flow tell you how much the company spent to which is the capex, capital expenditure, how much the company spent to grow its business. And then financing, how much the company look at the new borrowings and equity to finance their business itself. Yeah. So equity valuation concepts and basic tools. So it looks quite complicated over here, but I will quickly run through with you on valuation models, fundamental analysis valuation models. It boils down to three key methods. One is discounted cash flow models. This one is mostly used in company with stable earnings at the same time with stable cash inflows and outflow. Multiplier models, PE, I think is actually, why is it called relative valuation? Because all these things, right, all these parameters, PE, price to book, price to sales, can be used to compare with historical performance or to compare with the peers itself. And asset-based models is not widely used by analysts or fund managers. It is widely used by the private equity or business owner to value the company itself. Yeah. So on the valuation guide, maybe just a quick run through. On the cyclical companies, you need to use PE or PE over growth. Cyclical company and heavy industry, because it's asset based, right? You need to look at the enterprise value versus EBITDA, which I'll go through with you again later. And then companies with stable cash flow, you need to look at dividend discounted cash flow model, dividend discount model, as well as the yield, the dividend yield. Banks is the price to book correlated to return on equity on dividend discount model. Conglomerates, you need to discount of sum of parts. All this seems to be quite complicated for the what we call the beginner over here, but don't worry, I will go through each of these definition with you quickly on the next 15 to 20 minutes. Yeah. So during normal market condition, you can use all these kind of parameters to value this kind of industry and companies. Then when market trough means that the discount to asset base. When the market is not good, market is bearish on certain stocks such as construction, your property, you need to look at these kind of companies. They always discount to price to book or the RNAV. So companies with stable cash flow, you can during market trough, you can use their yield as a valuation method. So the most easiest way of using the parameters is the price to earnings ratio, whereby you use your share price divide by the earnings per share. So 1 ringgit divided by 10 cents, you get your PE of 10 times. So if you look at your share-based market cap basis, market cap again, how you derive, again, I mentioned, use 100 million times your share price of 1 ringgit, the company value is 100 million ringgit. So you divide by the earnings that they make a year. So earnings per share of 10 cents times the share base, you get your 10 million kind of earnings. So 100 million value of the company market cap divided by 10 million kind of earnings, you get your PE of 10 times. So advantage of using this is that it's very simple to calculate, as I shown over here. The inputs are easily available, easily to be interpreted, but it is not meaningful when the earnings is negative, because when negative, the PE become negative, so there's no meaning to it, right? And it's subject to accounting manipulations. So fully diluted PE, basically you take into consideration warrants after into the share base itself. So when you talk about fully diluted PE, you use the share price divide by the share base taking into account of warrants. So 1 ringgit divide by net profit of net profit after divide by 130 million, you get your 8.5 cents. So 1 ringgit divided by your 8.5 cents, you get your fully diluted PE of 11.8 times. This kind of method is used in company with warrants, yeah. So that's how you calculate it. And then normalized PE is that you remove out the exceptional gains. Just to share with you, most of the company, when they arrive at their net profit numbers or net losses number, sometimes they will incur some exceptional loss or gains that are not related to business. Say a manufacturing company, if they sell a subsidiary or they dispose a plant itself, right? Because they are manufacturing, you only look at the manufacturing kind of earnings. You need to remove out the gains that capture under income statement. So let's say net profit of 10 million after adding this is after exceptional gains of 5 million. You need to remove out 10 minus 5 million and divide by and use the share price of 1 ringgit divide by the earnings per share on the adjusted net profit basis, which I'll go through with you on our intermediate and advanced class later on. So PE to growth, PEG ratio. PE alone is not applicable to tech stock because tech stock is very expensive, right? You need to look at PEG because it take into consideration of growth. So let's say the company first year doing 7 cents, and apparently it will 1 year, 2 years later, the earnings will grow from 7 cents, 10 cents to 20 to 30 cents, right? So you use your share price of 5 ringgit, divide by your PE, which is the ultimately your year one earnings, the current 1 year forward kind of earnings, then divide by your growth. So how you get your growth is the 2-year earnings per share cumulated collective accumulation growth rate. So this one, how you derive is that you use 30 cents divide by your 7 cents power of 1/3. So you can actually Google this definition. This way of calculation is to take into consideration of the growth of the company. High growth company, you need to use PEG ratio. So essentially, anything below 1 times, right, means that the PE is trading at a discount to growth. Again, just to repeat, PEG of below 1 times means that the PE is trading at a discount to the growth itself. Yeah. So EV over EBITDA, I won't go through with you in details on this basic cost. Basically, they take into consideration of market cap, monetary interest, total debt minus cash versus EBITDA. Just to share with you, this one is mostly used in the heavy industries again, right? Aviation, AirAsia, we use EV over EBITDA. Telco, telecommunication, Maxis, Axiata, we use EV over EBITDA as well. So price to book is that when the company is making losses, you use their asset, their net tangible asset to value them. So net tangible asset is easily available. You just look at the shareholders' equity divide by the outstanding shares, you get your book value per share, then you divide by the price. Either that, you use net tangible asset, which means your total asset minus your intangible asset. That's how you derive it, yeah. And price to cash flow, most of the time Malaysia, we don't use the price over cash flow per share, but just to share with you also, this kind of method is to compare on the companies which derive a relatively stable kind of cash flow. Discounted cash flow model is even more complicated. Just to share with you, there are 3 ways in looking at it. Maybe I won't go through on the parameters over here, but DCF, again, like I mentioned, used to value a company with a stable earnings income stream, at the same time stable business, yeah. And RNAV, so let's say if you to value Genting, right? Genting itself, there are so many conglomerates under them. So many companies. You have Genting Malaysia where they own 50%, Genting Singapore, Genting Plantation. There are some cruise company, Genting Hong Kong. You can't just use PE or EV over EBITDA. You must use sum of parts. Sum of parts as in each of these individual company, you value them accordingly into all these subsea. You use target price on derive based on the stakes they have. Next time, if got opportunity, I'll go through with you on this sum of parts calculation. Then you ultimately you take into process of warrants and then fully diluted shares basis. So RNAV is used in conglomerates or big companies with a lot of assets underneath it. Yeah. So would like to share with you on this rolling PE concept. Most of the time, people when they calculate concept, they only calculate historical PE. Again, like I mentioned, when we talk about stock investing, value in company, you need to look at the earnings forecast on the company and value that earnings going forward versus current price. So let's say right now is January 2021. The company in 2021 is expected to do 25 million. So you use your market cap 100 million divided by 25, you got your PE of 4 times. But when we are in July itself, you always look at future, right? So instead of just whole year of 2021 earnings, because we are halfway through 2021, you need to take half of 2021 and half of 2022 as the measurement, half of 2021 earnings and 2022 earnings, and then take into consideration of that and look at the current PE, especially in July. So what if right now you are in December 2021? You cannot no longer using 2021 kind of earnings. You need to look at forward earnings, because 2021 you need to at December 2021 you need to value the future earnings of the company, which is 2022. So you use market cap 100 million divide by your forecasted net profit of 15 million. So you get your 6.7 times. And thanks very much.